Stop scrolling. Stop watching the candles. Stop pretending this is just another market move. What you're about to hear is not analysis, not speculation, not rumor. This is a countdown. Right now, somewhere in Zurich, the illusion that Switzerland is untouchable is collapsing in real time. And the trigger is not war, not politics, not currency, it is silver. Yesterday, January 10th, 2026, at exactly 3:17 a.m. Zurich time, a document left a building it was never meant to leave. A risk committee report. Internal, urgent, executive level. The kind of document that never reaches traders, never leaks, never escapes the boardroom. But this one did, and the words inside it are already sealing Switzerland's fate. 7 words. Not dramatic language, not hyperbole. 7 cold, institutional words that end a century-old reputation in global finance. Silver position threatens UBS and Swiss banking system. Those words appear in writing, signed, time-stamped, distributed to executives, and they confirm the nightmare that began the moment UBS absorbed Credit Suisse in 2023. The merger that was sold to Salvation did not save Swiss banking, it poisoned it. UBS is not just another bank, it is Switzerland's financial spine, the institution that absorbed Credit Suisse to prevent systemic collapse. One of only 5 LBMA market makers propping up the London silver market, the bank that anchors Switzerland's identity as a safe haven. And now, in its own internal documents, UBS admits its silver exposure is so large, so dangerous, and so unmanageable that it threatens not only the bank itself, but the entire Swiss banking system. This is not a press release. This is not an analyst note. This is a mandatory internal assessment delivered to UBS's risk committee. And the numbers inside it are staggering. UBS must close 5.2 billion ounces of silver short exposure. Not eventually, not over years. By February 10th, 2026, 30 days from the moment the report was written. And the document does something no bank document ever does. It names a price. When the exit is complete, silver is projected to trade at $298 per ounce. That number is not an opinion. It is not marketing. It is UBS's own risk-adjusted projection based on forced buying under deadline pressure. And I have the document. 9 pages. Crisis analysis, exit protocol, government coordination. On page 7, the conclusion is explicit. Median silver price upon completion of mandatory 30-day exit. $298 per ounce, plus or minus $37, depending on Swiss National Bank support and market liquidity. This is UBS telling itself that silver is going to nearly $300 because it has no other option. Before we go further, understand what makes this different from every other bank failure story you've ever heard. This is not HSBC unwinding over weeks. This is not Goldman managing exposure over quarters. This is UBS, Switzerland. The country money runs to when everything else breaks. For centuries, Switzerland has been neutral, stable, untouched. Wars burned continents, empires collapsed. Currencies failed. Switzerland stood above it all, and UBS was the final wall inside the fortress. When Credit Suisse imploded in March 2023, the Swiss government forced UBS to take it over. The narrative was simple. UBS would absorb the damage. The Swiss National Bank would provide liquidity. Stability would be preserved. The world would continue trusting Swiss banks with its wealth. That narrative was false. What UBS inherited was not just bad assets. It inherited a hidden derivatives bomb, and it detonated quietly, years later, inside UBS's own systems. The report is dated January 10th, 2026. The header reads, UBS Group AG Risk Committee Urgent Assessment. Subject, Silver Derivatives. Position, Systemic Risk Analysis and Mandatory Exit Protocol. The opening paragraph states that at 1 a.m. on January 10th, the UBS Risk Committee convened an emergency session after discovering that combined UBS and legacy Credit Suisse silver positions exceeded previously reported exposures by a factor of 3.8. The aggregate net short position, 5.2 billion troy ounces. That number alone is almost incomprehensible. It represents more than 8 times global annual mine production. And it exceeds UBS Group Tier 1 capital by 217%. In simple terms, UBS is already insolvent on silver alone. The report states clearly that this position poses unacceptable systemic risk to UBS, to Swiss banking stability, and to the credibility of the Swiss franc. The Swiss National Bank was notified immediately, and the response was not negotiable. Reduce silver exposure by 80% within 30 days, or emergency liquidity support will be withdrawn. Without S&B support, UBS becomes insolvent within 48 hours. That is the opening assessment. No spin, no cushioning language. UBS discovered in the middle of the night that it was short 5.2 billion ounces of silver and had 30 days to survive. The report mandates a complete exit from all silver positions by February 10th, 2026. The rest of the document explains how this happened, why it cannot be fixed quietly, and what it will do to the market. This is not a silver story. This is the largest due diligence failure in modern banking history. The first section explains the origin. When UBS acquired Credit Suisse in 2023, the deal was executed in 72 hours under government pressure. There was no time for full forensic due diligence. UBS relied on Credit Suisse's reported derivative exposures. Credit Suisse disclosed silver exposure of 400 million ounces. That number was false. Between December 2025 and January 2026, during post-merger system integration, UBS discovered discrepancies. A London metals desk at Credit Suisse had operated a separate trading book. It was never included in regulatory filings, never included in internal reports. This shadow book contained 3.8 billion ounces of silver shorts accumulated between 2015 and 2023. They were structured as OTC derivatives with non-standard settlement terms. They were classified off-balance sheet. Traders believed they were hedged. They were not. They were naked. By the time UBS found them, the original Credit Suisse management was gone. There was no one left to explain them. UBS's own silver short position was already 1.4 billion ounces. UBS believed the combined exposure was 1.8 billion ounces. The actual total was 5.2 billion. UBS did not know the truth until January 9th, 2026. Let that sink in. One of the most sophisticated banks on earth spent nearly 3 years unaware that it was sitting on a silver short equivalent to more than 6 years of global production. And that discovery is what triggered everything you are about to witness. The discovery of the shadow book alone would have been catastrophic. But that was only the first shock. What turned this into an existential crisis was the response from Switzerland's central bank. Because once the Swiss National Bank saw the numbers, there was no room for delay, negotiation, or discretion. According to the report, UBS notified the Swiss National Bank immediately after confirming the full size of the position on January 9th. By 3:00 a.m. on January 10th, the chairman of the SNB and 2 governing board members were already in an emergency meeting with UBS executives. The presentation was blunt, full disclosure, no hedging language. The numbers were placed on the table. Silver price at the time, $82 per ounce. Average entry price of the position, $39 per ounce. Mark-to-market loss, 223 billion Swiss francs. That loss alone exceeded UBS Alwas Tier 1 capital of 103 billion Swiss francs by more than double. On silver alone, UBS was already insolvent. The report records the SNB's response verbatim. The chairman made it clear that UBS only existed because the central bank had provided emergency liquidity during the Credit Suisse merger. That support was conditional, and a 5.2 billion ounce silver short was not just imprudent, it was reckless. It threatened the stability of the Swiss franc itself. If UBS failed, confidence in Swiss banking would fail. If confidence failed, capital would flee. And if capital fled, the Swiss franc would collapse. Switzerland could not allow that. The ultimatum was issued immediately. UBS had 30 days to reduce the silver exposure by at least 80%. If that reduction was not achieved, the Swiss National Bank would withdraw all emergency liquidity support. Without it, UBS would be insolvent within 48 hours. The deadline was documented in official correspondence at 4:30 a.m. January 10th, February 10th, 2026. No extensions, no compromise. Whoa, 80% of 5.2 billion ounces meant 4.2 billion ounces had to be closed. Not hedged, not rolled, closed. The report makes clear this was not a bluff. From the SNB's perspective, allowing UBS to carry that position was like leaving a nuclear device in downtown Zurich. Even if diffusing it destroyed the bank, a controlled failure was preferable to a currency collapse. But the central bank was not the only authority involved. Almost immediately, the Swiss government entered the picture. The report details that the Swiss Federal Council was informed through SNB channels on January 10th. That same day, the council held a closed emergency session to assess systemic risk. Their conclusion was grim but decisive. UBS could not be allowed to fail in disorderly fashion. But UBS also could not be allowed to endanger Switzerland's economic credibility. As a result, the Swiss Finance Ministry was authorized to begin preparing emergency nationalization legislation. If UBS failed to demonstrate substantial progress in exiting silver by February 10th, the government would move to nationalize the bank. Full state control. Capital injection to absorb silver losses, restructuring under government ownership. The estimated cost to Swiss taxpayers, 300 billion Swiss francs. The report states clearly that nationalization was considered a last resort, but politically unavoidable. Allowing a private institution to destroy Switzerland's safe haven reputation was unacceptable. A vote was tentatively scheduled for February 15th. UBS had until February 10th to prove it could solve the problem itself. The message was unmistakable. Fix this, or the state will take over. Public opinion was another factor. Swiss citizens were not yet aware of the silver exposure, but the report acknowledges that once it became public, outrage would be inevitable. In 2023, the public had been told the Credit Suisse bailout would stabilize the system. 3 years later, UBS was facing collapse due to undisclosed legacy positions. The political fallout would be severe. The government was preparing for it in advance. By this point, UBS was facing 3 simultaneous threats: a hidden derivatives bomb inherited from Credit Suisse, a central bank ultimatum that would kill the bank if ignored, and a government ready to nationalize if progress was not visible. Any one of these would have been destabilizing. Together, they removed every alternative. There would be no gradual unwind, no quiet restructuring, no backroom solution. Only one path remained: a forced immediate liquidation of silver exposure on a scale never attempted in financial history. The report then moves to the math, and this is where the situation becomes truly impossible. The aggregate net short position was broken down clearly: 1.1 billion ounces in COMEX futures, 900 million ounces in LBMA forwards, 2.3 billion ounces in OTC derivatives, 900 million ounces in unallocated account obligations. Total, 5.2 billion ounces. To comply with the SNB mandate, UBS needed to close 4.2 billion ounces in 30 days. The remaining 1 billion would be restructured into long-term obligations. That meant an average of 140 million ounces per day. But operational reality made that impossible. To establish credibility with the SNB, UBS had to front-load the exit. 70% of the covering would occur in the first 20 days. That pushed the daily requirement to 173 million ounces per day during the critical period. For context, the entire global silver market trades roughly 8 million ounces per day across all venues. UBS would need to buy more than 21 times the normal daily volume every day for nearly a month. The report states plainly that this has no historical precedent. This was not a covering operation. It was an emergency liquidation under existential time pressure that would cause extreme price dislocation. The comparison to global supply makes the scale even clearer. Annual silver mine production is approximately 800 million ounces. UBS was short the equivalent of 6.5 years of global production. Even if every mine on Earth sent all of its output to UBS and nobody else used silver for any purpose, it would still take more than 6 years to close the position. But UBS did not have 6 years. UBS had 30 days. The report then analyzed available supply within that window. Mine production over 30 days would provide roughly 66 million ounces. ETF redemptions, assuming aggressive selling, might release 276 million ounces. Private investor liquidation could add another 216 million. Industrial inventories perhaps 118 million. Sovereign sales around 90 million. Total potential supply approximately 766 million ounces. Against a requirement of 4.2 billion ounces, that left a physical shortfall of 3.4 billion ounces. The conclusion was brutal. UBS could access less than 20% of the silver it needed in physical form. The remaining 80% would have to be resolved through paper offsets, cash settlements, and deferred obligations. There simply was not enough silver in the world to do this cleanly. And that is when the report outlined the only strategy left. With physical supply nowhere near sufficient, the report makes it clear that UBS has no clean exit. What follows is not a strategy designed to protect markets. It is a strategy designed to survive. The document outlines a hybrid execution plan built around desperation, time pressure, and mathematical inevitability. UBS will buy everything that can be bought, settle everything that cannot, and defer whatever remains long enough to avoid immediate collapse. The first stage is physical acquisition. UBS will purchase all available physical silver in spot markets, regardless of location, up to a price ceiling of $350 per ounce. London, Zurich, wherever metal appears. The report estimates that even with unlimited willingness to pay, no more than 766 million ounces can realistically be sourced physically during the 30-day window. The second stage involves futures and forwards. UBS will close COMEX and LBMA positions by purchasing offsetting contracts. Approximately 1.6 billion ounces of paper exposure can be neutralized this way, but only by bidding aggressively and absorbing rising prices as other participants step aside. The third stage is cash settlement. For OTC derivatives that cannot be closed physically or through exchange mechanisms, UBS will negotiate buyouts. Counterparties will be offered cash payments in lieu of delivery, priced at a premium to spot. The report estimates 1.2 billion ounces will be settled this way, at an average of 112% of prevailing market prices. The fourth stage addresses unallocated accounts. UBS will convert roughly 650 million ounces of unallocated obligations into long-term purchase commitments with miners, deferring delivery into the 2027 to 2029 period. Together, these four actions total the required 4.2 billion ounces of reduction. The remaining 1 billion ounces will be restructured into extended obligations, pushed beyond the immediate crisis window. The projected cost is staggering. Physical purchases, at an average price of $268 mount to 205 billion Swiss francs. Paper covering, at an average of $212, adds another 339 billion. Cash settlements at 237 cost 284 billion. Deferred commitments contribute 190 billion more. Total gross cost, 952 billion Swiss francs. After asset liquidations and emergency funding from the SNB, the net cost to UBS is estimated at 189 billion Swiss francs. This is the price of survival. The report then turns to price modeling. External quantitative consultants were retained to simulate market impact. 3 independent firms, different models, similar outcomes. The optimistic scenario assumes smooth execution and minimal competitive buying. Even then, silver reaches $250 per ounce. The base case assumes moderate disruption and normal competitive dynamics, including approximately 200 million ounces of Chinese buying during the exit window. Terminal price, $298 per ounce. The severe scenario assumes cascade covering by other banks and aggressive front-running. Terminal price, $437 per ounce. The Risk Committee states explicitly that the base case is the most probable outcome, given current intelligence on Chinese and Middle Eastern demand. The 298 level is described as the equilibrium price, where UBS can complete its exit without triggering total market failure. But the report is careful to note there are no guarantees. If other shorts are forced to cover, the severe scenario becomes unavoidable. The document then draws a comparison that makes the scale undeniable. GameStop, January 2021. Short interest peaked at 140% of float. The stock rose from $20 to $500 in 2 weeks, a 2,400% move. UBS is short silver equivalent to 650% of annual global supply, not 1.4 times, 6.5 times. When scaled mathematically, UBS's position is more than 4 times more extreme than GameStop's. If silver moved proportionally, prices would become absurd. The report dismisses a literal comparison but emphasizes the point. This short is far more dangerous than the most famous squeeze in modern history. From there, the focus shifts to Switzerland itself. The report outlines how UBS's crisis threatens the entire national economic model. Switzerland relies on 2 pillars: financial services, which account for roughly 28% of GDP, and high-value exports such as pharmaceuticals, precision instruments, and watches, which account for about 43%. Both depend on a stable Swiss franc. Financial services depend on trust. Exports depend on predictable exchange rates. If UBS fails, trust collapses. If UBS is nationalized, credibility collapses. Either outcome risks capital flight. 3 scenarios are modeled. In the best case, UBS exits successfully, the SNB maintains support, and the franc remains stable. In the second case, UBS fails to exit, liquidity is withdrawn, nationalization follows, and capital outflows reach up to 80 billion Swiss francs. In the third case, cascade failure pushes silver above $400, multiple banks are hit, and capital flight exceeds 150 billion francs, with the Swiss franc dropping up to 30%. The report's conclusion is blunt. Switzerland cannot survive the third scenario. Then comes China. Swiss intelligence confirms that Chinese state entities are aware of UBS's forced exit. China views Western bank covering as an opportunity. With an M2 money supply exceeding $50 trillion, China can allocate tens of billions to silver purchases without constraint. The report estimates China will buy between 150 and 250 million ounces during the 30-day window. If UBS's buying accelerates price momentum, China will increase allocations to maintain ounce targets. The pattern is described as ratcheting. UBS buys, price rises, China buys more, establishing a higher floor. UBS pauses, China continues, preventing pullbacks. UBS is forced to chase the market higher day after day. If China buys aggressively, UBS's exit price rises into the $340 to $380 range. The report calls this Switzerland's nightmare scenario. China has no deadline, UBS does. The paper versus physical disconnect is addressed next. At the time of writing, spot silver is $82. Physical premiums are already elevated. Eagles trade far above spot. Bars carry double-digit premiums. As UBS covers paper shorts, paper prices rise, but physical supply tightens faster. Premiums widen. At $298 paper silver, physical bars are projected to trade between $405 and $450. The report states plainly that paper prices will become increasingly fictional. Physical prices will reflect reality. Then comes the retail angle. UBS plans to encourage selling. Advisors will recommend profit-taking. Sponsored media will warn of overbought conditions. The goal is to induce voluntary liquidation from retail holders to create liquidity. The report frames this as necessary. In plain language, UBS needs other people's silver. The execution timeline is then laid out. Phase 1, January 11th to 18th. Aggressive accumulation. Target, 1.4 billion ounces. Price moves from $82 toward $134. Phase 2, January 19th to 28th. Sustained covering. Target, 1.7 billion ounces. Price rises toward $217. Phase 3, January 29th to February 7th. Final push, target 1.1 billion ounces. Price reaches $298. Phase 4, February 8th to 10th. Verification, reporting to the S&B. Every day, UBS is the dominant buyer. There are no pauses, no reversals. The geopolitical impact is addressed next. BRICS nations hold an estimated 3.2 billion ounces of silver. At $82, those reserves are worth $262 billion. At $298, they are worth $953 billion. UBS forced covering transfers nearly $700 billion in wealth from a Swiss institution to Eastern governments. The irony is noted. Switzerland's banking crisis enriches geopolitical rivals, but survival takes priority. Mining supply is then examined. Production is declining, ore grades are falling, energy costs are up, environmental restrictions are tightening. New mines take over a decade to develop. Even at $298, supply cannot respond quickly. The market is inelastic. Price must rise until holders sell. The final section is the resolution. The risk committee unanimously authorizes the exit. All means are approved. The deadline is firm. Failure results in insolvency and nationalization. This is not optional, it is mandatory. So what does this mean? It means Switzerland as largest bank has admitted internally that silver is going to $298 because it is trapped. It inherited a position it did not know existed. The central bank has given it 30 days to survive. The government is prepared to take it over. UBS must buy. You do not have to sell. This is not speculation. This is a documented emergency assessment. The math is impossible. The timeline is fixed. The price is the consequence. The fortress has cracked. The safe haven is burning. UBS has surrendered. 30 days, 5.2 billion ounces, and no escape.